Are you planning to sell a house? Do you know there are effective strategies to help you minimize or eliminate capital gains tax liability? Today we will discuss capital gains tax in real estate. So whether you're a homeowner or investor, there's something here for you. If you're new here, please subscribe and smash that like button for more real estate tips. Before we get into the nitty-gritty, let's make sure we are all on the same page about what capital gain tax is and how it works. Capital gain is the profit earned on the sale of an asset, including real estate, which has increased in value compared to the original price paid for it. Capital gain tax is the tax imposed on the profit from that sale. In real estate, the holding period of the asset is a major factor in determining the type of capital gain on the property. If a property is held for 1 year or less before being sold, it is considered a short-term capital gain and the taxpayer will be subject to ordinary income tax rates on the property. On the other hand, if the property is held for more than 1 year, it is classified as a long-term capital gain, which is typically taxed at a lower rate than short-term gains. Another factor that can impact the capital gains tax rate in real estate is the taxpayer's income level. Higher income taxpayers may be subject to higher capital gain tax rates than those in lower income brackets. The nature of the asset that was sold can also affect the capital gain tax rate. For example, if a taxpayer sells a primary residence, they may qualify for certain exclusions or deductions that can lower their capital gain tax liability. Similarly, if the property sold is classified as investment or as a rental property, different rules and tax rates may apply. Overall, in real estate transactions, the capital gains tax rate will vary by taxpayer based on the holding period of the asset, your income level, and the nature of the asset that was sold. It is important to understand how these factors can impact your tax liability, so that way you can plan accordingly to minimize your tax obligations. Here are a couple of strategies you can apply. Strategy 1. Hold that property for more than a year. One of the easiest ways to reduce your capital gain tax is by holding your investment property for more than a year before selling it. Now let's provide an example for potential savings for a 400,000 house sold at a long-term capital gains tax rate. Suppose an individual purchased a house for 300,000 and held it for more than 1 year before selling it for 400,000. The capital gain on that property will be 400,000 minus 300,000, which will be 100,000. If the taxpayer falls within the 15% long-term capital gain tax bracket, they would pay a capital gain tax of $15,000, which is 15% of the 100,000. However, if the same individual had sold the house as a short-term capital gain, they will be subject to ordinary income tax rates, which would be significantly higher. By taking advantage of the lower long-term capital gains tax rate, the taxpayer in this example would save money on their tax bill compared to selling the property as a short-term capital gain. This illustrates the potential tax savings that can result from holding on to assets for the long term and benefiting from lower tax rates on capital gains. Strategy 2. Utilize a 1031 exchange. Have you heard of the powerful 1031 exchange, also known as a like-kind exchange? It is a tax-deferred exchange that allows real estate investors to defer paying capital gains taxes on the sale of investment property if they reinvest the proceeds into a similar property. This powerful tax strategy can help investors upgrade their portfolio, diversify their holdings, and even benefit primary residence homeowners in certain situations. Now, personal residences do not qualify for a 1031 exchange. At the end of this video, I will share how 1031 exchange can benefit primary residence homeowners, so stick around. Here are guidelines for a 1031 exchange and how it can benefit investors. Number 1, property qualifications. To qualify for a 1031 exchange, both the property being sold and the property being purchased must be held for investment or business use. The properties involved in the exchange must be like kind, meaning they are of the same nature or character, even if they are different in quality or grade. Number 2, timeline. There are strict timelines that must be followed in a 1031 exchange. 1. 45-day identification period. The investor has 45 days from the date of selling the relinquished property to identify potential replacement properties. This identification must be in writing, signed by the investor, and delivered to the qualified intermediary handling the exchange. The 45-day period includes weekends and holidays. The second timeline is 180-day exchange period. The investor must complete the purchase of the replacement property within 180 days of the sale of the relinquished property. The 180-day period also includes weekends and holidays, just like the previous 45-day period. If the investor's tax return is due before the end of the 180 days, the exchange must be completed by the tax return due date, including extensions. For example, if an investor sold a property on August 1, 2024, the identification of potential replacement property must be done by September 15, 2024. The purchase of that replacement property must be completed by January 28, 2025. For the 1031 exchange to remain valid, you must adhere strictly to these timelines. Number 3, equal or greater value. The investor must invest all proceeds from the sale of the relinquished property into the replacement property to defer all capital gains taxes. The replacement must be equal or greater in value than the relinquished property to defer all taxes. Number 4, intermediary. To facilitate a 1031 exchange, investors must work with a qualified intermediary who will hold the funds from the sale of the relinquished property and ensure that that exchange complies with IRS regulations. Those are the rules and guidelines. Now let's look at how a 1031 exchange can help investors. First, portfolio upgrade. A 1031 exchange allows investors to upgrade their portfolio by selling underperforming properties and acquiring higher performing assets without incurring immediate tax liabilities. This can help investors optimize their real estate holdings and increase their overall return on investment. For example, if your current portfolio has property A, and property A is a small aging apartment building in a declining neighborhood generating modest rental income with a market value of $1 million and an annual net income of $50,000. And your goal is to sell and reinvest in a property with higher income potential and better growth prospects. Then your first step will be to sell the underperforming property for $1 million, say on the 1st of September 2024, and initiate a 1031 exchange to defer capital gains taxes. The second step will be to find a replacement property. Within 45 days, that is by October 15, 2024, you must have found that property or those properties since you sold on September 1st. For example, if you find 2 potential replacement properties, let's call them property B and property C. Property B, a newer, larger apartment complex in a growing suburb with a market value of $1.5 million and an annual net income of $120,000. And then property C, a commercial retail space in a busy downtown area with a market value of $1.5 million and an annual net income of $130,000. Your last step, your third step, will be to acquire the replacement property. This must be done within 180 days. That will be by January 28, 2025. You must have completed the purchase of that property, let's say property B, for $1.5 million. And that means you use your $1 million proceeds from the sale of property A and secured additional financing for the remaining $500,000. Now, in this scenario, the benefit of the portfolio upgrade include: first, increased income. Property A generated 50,000 in annual net income, and then after, property B is projected to generate 120,000 in annual net income, significantly increasing your cash flow. Secondly, better location and growth potential. Property B is located in a growing suburb, offering better long-term appreciation prospects compared to property A that was in a declining neighborhood. Thirdly, deferred tax liability. By utilizing the 1031 exchange, you as an investor, you have deferred capital gains taxes on the sale of property A, preserving more capital for investment. In summary, a 1031 exchange can help investors upgrade their real estate portfolios, spread risks, and enhance stability by moving from underperforming to higher performing assets, thereby increasing their overall return on investment while deferring immediate tax liabilities. Now, the icing on the cake. How can 1031 exchange help primary residence homeowners? While primary residences do not qualify for 1031 exchange, homeowners can still benefit from tax advantages when selling their home. Under current tax laws, homeowners can exclude up to 250 or 500,000 for married couples filing jointly of capital gains from the sale of their primary residence if they meet certain ownership and use requirements. This exclusion can help homeowners save on capital gains taxes when selling their primary residence. Imagine John and Mary, a married couple, bought a home in 2010 for 300,000. They live in the home continuously as their primary residence. Then in 2024, they decide to sell the home and find a buyer who agrees to purchase it for 800,000. The capital gain from the sale will be sales price $800,000 minus purchase price $300,000 equals $500,000. Under current tax laws, since John and Mary are married and filing jointly, they can exclude up to 500,000 of the capital gains from the sale of their primary residence, provided they meet the ownership and use requirement, which is that they owned and lived in the home for at least 2 of the 5 years preceding the sale. In this case, their entire 500,000 capital gain is excluded from taxable income, meaning they do not owe any federal capital gains tax on the sale. In conclusion, a 1031 exchange is a valuable tax strategy that can help real estate investors upgrade their portfolio, diversify their holdings, and defer paying capital gains taxes on the sale of investment property. While primary residence owners cannot participate in a 1031 exchange, they can still benefit from tax advantages when selling their home. Remember to consult your accountant or tax advisor to ensure you're making the best financial decisions for your specific situation. Thank you for watching, and we hope you found this information helpful. Don't forget to like, share, and subscribe for more financial tips and advice. Until next time, happy house hunting.